Hey everyone, and welcome to another deep dive. We're going to be tackling technical analysis today. And to help us decode the charts, we're turning to a true legend, Martin Pring, and the latest edition of his book, Technical Analysis Explained. So get ready to transform those intimidating charts into a roadmap for market success.
That's what we're aiming for. It's like, people always talk about predicting the market, right? But with technical analysis, it's more about understanding the language it speaks.
I like that. It's about spotting those patterns, those tendencies that give us an edge. Speaking of patterns, Pring kicks things off with something he calls peak and trough progression. And honestly, his beach analogy really clicked for me.
It's such a visual way to think about it. Picture a rising market. What do you see?
Well, I see those peaks, those highs getting higher and higher, right?
Exactly. But here's the thing. It's not just about higher highs. In a true uptrend, those lows, those troughs between the peaks, they need to be climbing higher too, like waves coming in further up the beach with each surge. That's how you know the tide is truly turning in your favor. So it's that steady upward progression of both the peaks and the troughs. It's about that underlying momentum, that consistent force pushing things higher. But how much of a pullback, how much of a dip against the main trend is considered normal? Pring introduces this one-third to two-thirds retracement concept that sounds kind of important.
It is, and it can be a bit tricky to wrap your head around at first. Think of it like this. You know how a wave rushes in, then pulls back a bit before the next one comes.
Yeah, it doesn't just retreat all the way back to the horizon.
Exactly. That pullback, that temporary dip, that's the retracement. And a retracement of one-third to two-thirds of the previous move, that's pretty standard. It's like the market taking a breather, gathering energy for the next push forward.
Okay, so if a stock, let's say, jumps up by $10, a pullback of, say, $3 to $6 wouldn't necessarily be a reason to panic.
Probably not, no. It's all part of that natural ebb and flow. But remember, and this is crucial technical analysis, is a tool for probability, not prophecy.
Yeah.
It's not about predicting the future with absolute certainty, but rather understanding the tendencies, the likelihoods.
We're tilting the odds in our favor, not trying to time the market perfectly. And this is where Pring's concept of intermediate cycles comes into play, right? It's like those waves within a larger current, adding another layer of, well, let's call it intrigue.
Absolutely. These intermediate cycles, they play out within that bigger, longer-term trend. Pring talks about two main types: primary intermediate movements, which go with the main trend, and secondary movements, which go against it.
Okay, so if the market's in a general uptrend, a primary intermediate cycle would be a rally within that uptrend, while a secondary cycle would be a pullback, even though the overall direction is still upwards.
You got it. Now, here's the kicker. Pring points out that those secondary movements, those counter-trend dips, those can be tricky. They can really trip up traders who mistake them for a full-blown trend reversal.
So even seasoned pros can get caught off guard by those counter-trend currents.
All the time. They see that pullback, that dip, and they think, this is it. The tide is turning. Time to bail. But often, it's just a temporary blip, and the main trend resumes. It's all about understanding the context, the bigger picture.
It's like those secondary movements are these rogue waves trying to knock us off course. So how do we steady ourselves? How do we, as Pling puts it, draw those lines in the sand?
I'll admit, when I first started looking at charts, all those lines and indicators kind of felt like a foreign language.
Oh, I hear you. It can definitely feel overwhelming at first. But once you start to grasp the basic principles, it's like a whole new world of insight opens up. And those trend lines, they're like those first words you learn in a new language, They're foundational.
So instead of just seeing a jumble of price movements, we can start to identify the underlying direction, the flow.
Exactly. Trend lines connect those peaks and troughs we've been talking about. They give us a visual representation of the prevailing trend, whether it's up, down, or even sideways. And here's where it gets really interesting when those trend lines are broken. Because Pring points out that it's not just about whether a trend line is broken, but how it's broken, right? The angle, the steepness of that break, that tells a story too.
It's like, imagine the trend line is a wall and the price action is a force trying to break through. Now you can have a sudden explosive break, like a cannonball blasting a hole right through the wall.
Okay, dramatic. I like it. So that's a sharp, almost vertical break through the trend line.
Exactly. And often those types of breaks, they're more likely to be temporary disruptions. The wall might have a hole in it, but it's still standing. The original trend is more likely to resume.
Okay, so a sharp, sudden break, even if it seems dramatic at the time, might not be as significant as it first appears. It's like the market taking a quick breather, shaking things up a bit, but then ultimately resuming its course. What about a slower, more gradual break? Is that when we should be more cautious?
Yeah, that's a different story. Think of it like a steady push against that same wall, eventually wearing it down until it crumbles. That's more like a gradual trendline break. And it often suggests a more significant shift in momentum, a potential trend reversal.
Fascinating. It's like the market is speaking to us through these patterns, these subtle clues. And speaking of clues, Pring also talks about those zones where prices seem to have a memory, where they bounce around within a certain range. Those are the support and resistance zones, right? Those levels where the market seems to, I don't know, put up a fight.
Exactly. Traders, we're creatures of habit, right? We remember past battles between buyers and sellers, those price levels where the market struggled to break through. And those memories, they create these psychological barriers, these support and resistance zones.
So even though there's no physical barrier on a chart, these price levels take on a significance, a weight, based on past market activity. It's like an invisible force field. And this is where things get kind of mind-blowing because to help identify these zones, Pring introduces, wait for it, the Fibonacci sequence. Math was never my strong suit, but I'm intrigued. What's the connection between these mystical numbers and the financial markets?
Well, first off, let's remember Fibonacci numbers pop up everywhere in nature, right? From the spiral of a seashell to the arrangement of petals on a flower. And it turns out these same ratios, particularly 61.8% and 38.2%, they show up in market movements as well.
Okay, so we're talking about those golden ratios we often hear about. How do we actually apply those to the market?
So let's say a stock has a big move, either up or down. By applying those Fibonacci ratios to that move, we can identify potential levels where the price might reverse or stall. It's like having a cheat sheet for spotting those key turning points.
So Fibonacci levels can help us anticipate where those support and resistance zones might be lurking. I like it. But Pring doesn't stop at price patterns, does he? He also dives into volume, that often overlooked aspect of market analysis. I always thought high volume simply meant a strong trend, but he throws in a fascinating twist, doesn't he?
Yeah, volume can be deceiving. Think of it this way. Imagine a packed stadium during a championship game, right? The crowd is going wild, but here's the thing. That roar, that energy, it could be for a game-winning touchdown or a heartbreaking interception. You need to look at the scoreboard to know for sure.
So high volume just tells us there's a lot of energy, a lot of conviction behind a move, but it doesn't necessarily tell us the direction of that move.
Exactly. We need to look at the context, the price action, to see what that volume is confirming.
So high volume on a breakout to new highs, that's the crowd celebrating a victory, right? But high volume when a stock is tanking, that's the sound of panic, the crowd heading for the exits.
Precisely. And to help us track these shifts in volume, Pring introduces us to volume oscillators, which are essentially tools that measure the momentum of buying and selling pressure.
Okay, I can already tell this is a whole other rabbit hole to explore. But before we get too deep into those weeds, what's the key takeaway for someone new to a volume oscillators? What's the one thing they should remember?
Don't assume that high readings always mean overbought conditions. Remember the stadium analogy. That roaring crowd could mean a blowout win or a crushing defeat. We need more information to interpret those signals correctly.
So it's like we've got this whole crowd of traders, and volume is telling us how loud they are, how much they're freaking out or celebrating, but we need the price action, that scoreboard, to tell us what they're actually reacting to.
Spot on. Volume without context is like, well, just noise. But Pring doesn't stop at just individual stocks and indicators. He takes us up to a higher altitude, so to speak.
Zooming out to the bigger picture, right? Because no stock exists in a vacuum. The whole market, the economy, even global events, they all play a role.
Exactly. And that's where things get really interesting because Pring dives into areas like market cycles and sentiment. And honestly, this is where his insights really clicked for me. You see, just like the ocean has its rhythms, its seasons, its tides, markets have cycles too.
Okay, yep, we hear about cycles all the time, but it's easy to get lost in the weeds. Are we talking about those short-term swings or those, like, legendary long-term cycles, those Kondratiev waves that span decades?
Pring talks about both, actually. He emphasizes that understanding where we are in a cycle, whether it's a short, intermediate, or long-term cycle, can make a huge difference in how we interpret those technical signals we've been discussing.
So a strategy that works great in a bull market when the tide is rising might be disastrous in a bear market when the tide goes out. It's like we need to know whether to ride the waves or see shelter on shore.
Precisely. And that's where sentiment comes in, because sentiment, that collective mood of the market, can be a powerful force, but it can also be incredibly misleading.
Yeah, sentiment is like notoriously fickle. One minute everyone's euphoric, the next they're panicking. How do we even begin to measure something as intangible as sentiment?
It's tricky, but Pring offers some really insightful perspectives. He talks about how extremes in sentiment can actually be contrarian signals.
Okay, so like when everyone's wildly bullish, that's actually a sign that the market might be due for a downturn. The old buy when there's blood in the streets idea.
Exactly. When everyone's on one side of the boat, so to speak, it doesn't take much to tip it over. Pring gives this great example. He talks about magazine covers and how those often reflect extremes in sentiment.
Oh, yeah. Like, remember that classic Birth of the Bull cover near the 1982 market bottom? Classic contrarian signal.
Exactly. When everyone's declaring a new era, it's often a sign that, well, the crowd might be getting a little ahead of themselves. So we've got those technical tools to analyze price and volume, we've got an awareness of market cycles, and we've got this contrarian lens to help us interpret sentiment. It's like Pring is giving us this whole toolkit for navigating the markets.
It's impressive, really, how he manages to tie together all these different aspects of market analysis, from those basic chart patterns to those broader economic and psychological forces at play.
It's all connected. And that's what makes technical analysis so fascinating, but also so challenging.
Mm.
Because it's not just about memorizing a bunch of rules. It's about understanding the principles, the underlying forces at work.
It's about becoming a student of the market, right? It's about being observant, being adaptable, and never stopping learning.
Exactly. And Pring, I think he really embodies that spirit. He encourages us to question assumptions, to experiment, to find what works for us. There's no one right way to trade, but by understanding these principles, these tools, we can significantly tilt the odds in our favor.
And that's what this deep dive is all about, giving you the knowledge, the insights to become a more confident, more informed trader and investor. So keep those charts handy, keep those risk management strategies front and center, and we'll catch you on the next deep dive. Happy trading, everyone.